Good morning. Today we're waking up to a reality that's hitting millions of people around the world: the steady climb of oil prices. If you've noticed gas prices rising lately, you're not alone. At the pump, those numbers keep ticking upward, and it's something drivers everywhere are feeling. The global price of oil is climbing, and it's hitting our wallets. Every time you fill up, you're paying a little more, and that extra cost adds up over time. This isn't just about filling up your car. Oil prices affect everything from groceries to shipping costs. When oil gets expensive, transporting goods becomes pricier, and those costs trickle down to the price tags we see in stores. The recent surge in crude oil prices didn't happen overnight. It's the result of a complex web of factors that have been building for weeks, even months. Over the past few days, both Brent crude and West Texas Intermediate have jumped, with Brent trading above $66 a barrel and WTI over $62. These are the benchmarks that set the tone for oil prices worldwide. These numbers may seem distant, but they directly impact what you pay at the pump. The higher the price per barrel, the more it costs to refine and deliver gasoline to your local station. The market is reacting to a mix of global events and economic signals, including international tensions and a weaker US dollar. Political instability in oil-producing regions can send shockwaves through the market, making prices unpredictable. When the dollar drops, oil becomes cheaper for other countries, boosting demand and pushing prices higher. This currency effect is a key reason why oil prices can swing so quickly. Recent soft U.S. jobs data has led many to expect the Federal Reserve might cut interest rates, further weakening the dollar. Lower interest rates can stimulate economic activity, but they also make the dollar less attractive to investors. Investors are watching for any sign of supply disruptions or strong demand, bidding prices up at the slightest hint. Even rumors of a supply cut or a sudden spike in demand can send prices soaring. It's a perfect storm: global uncertainty, cautious supply, and currency shifts all driving oil prices higher. Weather events, geopolitical conflicts, and production cuts by major oil exporters all add to the volatility. Even small changes in the market can have big effects on what you pay. A few dollars more per barrel can mean higher costs for food, clothing, and everyday essentials. Understanding these forces helps us anticipate what might come next. By keeping an eye on these trends, we can better prepare for changes in our own budgets. The story of oil prices is global, but its impact is felt right at home. Whether you're commuting to work, buying groceries, or planning a trip, these price shifts touch every part of daily life. Let's break down what's happening and why it matters, so you can stay informed and make the best choices for you and your family. Today, September 9th, 2025, oil markets are tense and all eyes are on the latest developments. The energy sector is buzzing with activity as traders, analysts, and investors try to make sense of a rapidly changing landscape. Both Brent and WTI crude futures have edged up again, with Brent at $66.17 and WTI at $62.03 a barrel. These numbers may seem like just a few dollars difference, but in the world of oil, even small shifts can have massive ripple effects across the global economy. These small increases represent millions of dollars in value and set the tone for the day's trading. Every uptick is closely watched, as it can signal broader trends and influence decisions from Wall Street to Main Street. The market is reacting to two big stories that are dominating headlines and shaping sentiment among investors and policymakers alike: a smaller than expected production increase from OPEC+, which has left many wondering if supply will be able to keep up with demand as economies recover and energy needs grow, and escalating tensions in Eastern Europe, where geopolitical uncertainty is adding a new layer of risk to an already fragile market. Traders are betting that supply will stay tight, especially with the threat of new sanctions against Russia looming large. Any disruption in Russian exports could send shockwaves through the market. This uncertainty is fueling volatility and driving prices higher. Every new development, whether it's a diplomatic statement or a change in production quotas, is causing sharp swings in the market. The market is forward-looking. Today's prices reflect bets on what's coming in the next few months, not just what's happening right now. Investors are trying to anticipate the next move before it happens. Right now, the expectation is that geopolitical risks and OPEC+'s cautious approach will keep oil supplies tight, making it difficult for prices to come down in the near term. That's why prices remain elevated, despite concerns about a possible global economic slowdown. Even as some worry about weaker demand, supply constraints are keeping the market on edge. The focus is on supply, and every headline is moving the market. Traders are reacting in real time, adjusting their positions as new information comes in. The next moves from OPEC Plus and world leaders will be critical. Their decisions could determine whether prices stabilize or continue to surge, making this a pivotal moment for the oil market. To understand oil prices, you need to know about OPEC Plus. OPEC, led by countries like Saudi Arabia and the UAE, controls a huge share of the world's oil. OPEC Plus includes Russia and other major producers, giving the group even more influence. They meet regularly to set production targets, aiming to keep prices stable but profitable. Recently, OPEC Plus announced a modest increase of 137,000 barrels per day for October, a cautious move in a market that uses nearly 100 million barrels daily. This small increase signals they're not flooding the market, keeping supply tight and prices high. Many hoped for a bigger boost, but OPEC Plus is playing it safe. Their decision is a key reason oil prices are climbing this week. OPEC Plus' latest production increase is much smaller than previous months. In August and September, they raised output by over 500,000 barrels per day. Now, it's just 137,000. Why the caution? They're worried about a supply glut if non-OPEC Plus countries, especially the US, keep pumping more oil. Too much supply could crash prices, hurting their economies. By making only a small increase, OPEC Plus is testing the waters, meeting some demand without risking a price collapse. This strategy gives them flexibility to adjust later if needed. For now, they're signaling prudence and patience. The group is watching global demand and other producers closely. It's a delicate balancing act to protect their interests. The Russia-Ukraine conflict is adding major risk to oil markets. The threat of new Western sanctions against Russia's oil industry is making traders nervous. Russia is a top 3 oil producer, so any disruption could remove millions of barrels from the market. Even the possibility of sanctions is enough to push prices higher. The US has already moved to limit Russia's oil revenue, and more measures could be coming. The uncertainty over what sanctions might look like is driving up the risk premium in oil prices. As the conflict escalates, the market is bracing for potential supply shocks. Until there's clarity, prices will stay elevated. The US and Europe are coordinating their response to Russia's actions in Ukraine. President Trump is meeting with European leaders to present a united front, but progress has been slow. Sanctioning Russia's oil industry is a powerful tool, but it's risky. It could spike global prices and hurt Western economies. European nations are especially cautious, given their reliance on Russian energy. The challenge is to pressure Russia without triggering an energy crisis at home. Ongoing talks are focused on finding this balance. The oil market is watching these negotiations closely. The outcome will shape prices in the weeks ahead. The US is also using tariffs to influence the flow of Russian oil. Recently, a 50% tariff was imposed on India to discourage it from buying Russian crude. But India, needing affordable energy, continues to buy from Russia, showing the limits of US pressure. The US hasn't imposed similar tariffs on China, likely due to the complex economic ties between the two countries. This selective approach highlights the geopolitical calculations at play. Meanwhile, President Trump keeps the door open for direct talks with Putin. The administration is using both economic pressure and diplomacy as leverage. For oil markets, this means unpredictability. Any breakthrough or escalation could swing prices sharply. The world is watching for the next move. Every decision has global ripple effects. All these global moves hit home in a big way. The ripple effects of international decisions and market fluctuations are felt right in our living rooms. Higher oil prices mean higher gas prices. Simple as that. Every time you fill up your tank, you're directly impacted by the global oil market. But it doesn't stop there. The cost of oil seeps into almost every aspect of our daily lives. Rising energy costs drive up prices for everything from food to electronics, as transportation and production get more expensive. The trucks that deliver goods, the factories that produce them, all rely on energy. This is inflation in action. Your dollar buys less. The same amount of money now gets you fewer groceries, less gas, and fewer services. Businesses feel the squeeze too, facing higher costs for deliveries, manufacturing, and operations. They have to make tough decisions to stay afloat. Some may raise prices or cut back on hiring, slowing economic growth. This can lead to fewer job opportunities and higher unemployment rates. For families, it means tighter budgets and tougher choices. Deciding between essentials becomes a daily challenge. Oil prices shape household expenses, business plans, and even government policy. Governments may need to adjust taxes or subsidies to manage the economic impact. When prices are high and volatile, everyone feels the uncertainty. It affects consumer confidence and spending habits. That's why these global oil stories matter to all of us. They influence our daily lives in more ways than we might realize. What happens in OPEC plus meetings or diplomatic talks affects your wallet. The decisions made in these rooms can change the course of our economic future. Looking ahead, the oil market's next moves depend on a few key factors. Will the US and Europe impose tougher sanctions on Russian oil exports? Any announcement could send prices soaring or falling. OPEC's next production decision will also be crucial. Will they stay cautious or open the taps? Economic data from the US and China will signal whether global demand is rising or falling. Central bank decisions on interest rates could also shift the outlook for energy consumption. Right now, supply risks and geopolitical tensions are keeping prices high. The market is on edge, watching every headline. The story of oil is far from over, and it affects us all.